Welcome to the Scale Up Valley podcast, where we bring the best founders, CEOs, and investors to help you scale a business from 1 million to 1 trillion. Today's guest is Andrew Butt, the founder and CEO at Enable. Andrew, welcome to the show.
Thank you, Mike. It's great to be here.
My pleasure. So you have an amazing story. You started the company in December of 2016, so almost 7 years next December. You started in the UK. You have moved to the Valley, where the ones who have the privilege to see the YouTube video will be able to see your background. The ones who are listening through the other podcast platforms will not be able to see it. But we have here an amazing story, 500 plus employees, more than 100% year-over-year growth, amazing Series A, B, and C already raised, being the last year, the 94 million Series C completed, right? So
Yeah.
with over 10 million plus ARR and growing fast. So I think it's a good introduction overall to the kind of business that we'll cover today, and the amazing journey that you are going through. But tell us more about you, your background, and Enable, and set us up for success and for the next hour.
Okay, no pressure there. So yeah, I mean, I was always kind of drawn to computing as a child, and building computer programs, and I was also very drawn to business. And my father ran accountancy firm, so he had like a CPA practice in the UK and worked with lots of small business owners. So I combined those interests at a young age and was kind of building software for anyone I could. And it was all kind of business software from day one. I was probably quite boring. I didn't do gaming or anything like that. It was all business software. And then my other real hobby that I often talk about is flying. So I originally wanted to be an airline pilot, and I was lucky to meet a flying school who I could hang out at the weekend and build software for them, and also meet some fascinating entrepreneurs who were learning to fly and had great businesses. So that really kind of set me up to meet people and learn about business. And then I remember when the web started to really take off in the late 90s, 2000, that's when I started to build web software, internet-based software, which of course was a novelty in those days. And the story goes on, but that's how I got started.
Yeah. And it's fair to say that this is almost your third business, right? So and your first business was called Enable Info Matrix, which is kind of coming back to Enable. So you were able also to exit that business to Sovereign Capital Private Equity in 2010, correct? Anything
Yes.
that you'd like to add there?
Yeah, I mean, I think my background was always in service businesses before I kind of started this one and came out to Silicon Valley and really focused on building the products that we have now. And so what that meant was we were building software for other people, and we were hiring kind of software engineers, and were meeting lots of fascinating companies who all wanted us to build software for them. And Info Matrix was actually a client of ours. So we were building software for them, and they were experts in their space, which was property information, construction compliance, health and safety compliance, this type of thing. And I still talk to those guys today. They're great people. And it ended up where I invested in the business with one of my partners, and created like a joint entity, and we were building software for the company, and then we became investors and directors in the company as well, and grew that one. And you're right, it was eventually acquired, and it was part of a buy and build strategy. So Sovereign were buying different companies, sticking them together, and they've created a really fantastic group as a result of that.
Love it. And after that, you are also the co-founder and managing director of another entity, the DCS Group. I know that you have an amazing story that you were able to bootstrap Enable. So your last business, and the business that we are covering today, of course, from a services business, and then you invested all the profits on building the product organization, the SaaS organization that you have today at Enable, which we know it's something that a lot of founders tried before, and it's not an easy path to go through. I'm not sure if this previous organization, that's what has been transformed into the Enable product business, or if it is even another business before that.
Well, yeah, no, you're absolutely right. So DCS Group is now the largest distributor in the UK, and it works with brands like Procter and Gamble, Unilever, and Gillette, and so on. And the founder and owner of that business is an entrepreneur called Dennis Short, and he's a very, very successful entrepreneur. Him and I actually met at the flying school, believe it or not. So he was learning to fly, and I was hanging around, building software for them. And so we got together, and he actually made me an offer, and we created a company called DCS e-commerce, which kind of sat within the DCS group and was building software. And it was DCS which really was the inspiration for what we do today, because they use these things called rebates, B2B rebates in their industry. And that was a significant kind of growth driver for DCS, and there was no software to manage that well. So that kind of eventually led us to build the Enable product that we have today, and it was kind of incubated within DCS.
And this was a services business. So, and then when you
Yes.
start Enable, it already starts as a product business.
Exactly. So DCS e-commerce that we created is a joint venture, if you like, between Dennis and myself, and it was kind of created a DCS e-commerce. Yeah, that was services, so building software for lots of people, bespoke software, custom software, and then eventually we built the product in that company, and then we kind of separated that out into Enable at that point when the product was ready.
Sounds amazing. So, and then we got to December of 2016, and tell us more about what is Enable about.
Yeah.
And
Absolutely, yeah. So Enable is a B2B SaaS platform that is used by manufacturers, distributors, and retailers all over the world in almost every industry. And it's really about how you create trading agreements between yourself and other companies in the supply chain, and how you use and manage rebates. And a rebate we've defined is any funds that flow back through the supply chain. So typically, if I spend money with you, then when I hit a certain target, you'll give me some money back. And this, it turns out, this is a huge kind of phenomenon that goes on everywhere, but it was kind of almost under the radar until a few years ago. And these kind of rebate programs have become a lot more complicated and a lot more surgical. So a simple example, maybe a few years ago, if I buy $100,000 of product from you, you give me $2,000 back. That's really easy and simple. You could do that, no problem. But now it's much more product specific. There's different tiers. So if I buy 100,000 of product A and I do that within 2 months, I might get 5% back. But if I buy a different product and I get something else, and it becomes very, very complicated. So we saw that this was actually responsible for all of the margin, all of the profit margin in a distributor and a retailer. And it was also the single biggest cost that a manufacturer had. And the whole thing was just not that effective. It didn't work well. There wasn't modern software. So Enable is the kind of modern cloud platform to do all of that across the supply chain.
Yeah. And just remind us, so what is kind of the ideal customer profile of Enable?
Sure. So really it would be any distributor or retailer or manufacturer where they are certainly physical goods. So it's across, literally, you can imagine automotive components. It's across, pharmaceuticals, office supplies, construction materials. So all of these physical things, and even now we're in non-physical as well. So it's very broad. It's I think people thought it was a vertical kind of solution at first, but actually it goes across so many industries.
Horizontal.
It's much more horizontal.
Right. So it's really, the category is kind of rebate management, right? So, and then you have different sectors who are almost sector agnostic, but of course sectors who have to deal with rebates, right? As you were explaining. And okay, in terms
Yeah.
of the size of the companies, I think that you started more with enterprise, correct?
That's right. Yeah. So we started because in the early days we were bootstrapping and, like you said, using the
Yeah,
profits from the services company to fund this. So we had to get big contracts because we had to
right.
pay the payroll. So we were working with very large companies that had huge amounts of these rebates, and then if we could kind of save them 2 or 3% even, that would be still a large amount of money, and that's where we started. And then as we've grown, we've kind of actually gone up market and down market, so we're winning bigger customers and we're winning smaller customers.
Okay.
But I guess just to explain a bit more,
Yeah,
rebates are really the currency of the supply chain. It's how the supply chain
yeah,
operates. Just like sales commission in a company drives a sales team,
right.
rebates drive distributors and retailers in the supply chain. So you're right that the category we're building is rebate management, but the broader mission of Enable is to enable trusted trading relationships to serve customers better together. So that means really just helping the supply chain to work better by using these types of agreements.
Got it. And so we were talking about the category, the industries that you started more with, let's say maybe mid-market, mid-market,
Yeah.
and then you went upstream and downstream with enterprise and maybe the mid-market and the small business side as well, right? So,
Yes.
and something that is also interesting is that you started international from day one with English speaking countries like UK, US, Canada, Australia, for instance, correct?
Yes. Yes, we did. Yes, we did. So we started purely in the UK, but we were very quickly getting inquiries from all over the world. And you're right, that US was a big source of inbound, and then Canada and Australia and others, but those were big ones. And so that was from an early stage. And for example, companies in the US were saying to us, we don't really want to use you because you're not in the US, but we can't find anything in the US that does what you can do. So they sort of signed
Great
up
problem.
anyway. Yeah, and we were kind of providing UK hours support, which wasn't very good because our US customers in the middle of the day, everyone went home. But it
Right.
didn't take me too long to realize that I needed to set up in the US, for example, and now we're in other countries as well. But we got quite far bootstrapping from the UK and serving those international companies.
And in those initial times, did you start more East Coast oriented, or did you start serving almost inbound any customer that was coming from the US?
I think we would take anything inbound that we could get as long as there was a good product fit. So obviously we
Yeah.
wanted to make sure the product would work well, but we would almost just do whatever it took to win a customer anywhere in the world if they came to
Yeah.
us.
Yeah, I'm just asking this because sometimes we have this, especially if we are based in the UK or in CET, in more Germany, France, Spain. Um, yeah, it's -8 Pacific time, -5 Eastern
Yeah,
time, right? So at -5, we are still able to have a 3 p.m. meeting, which would be kind of 10 a.m. For the East Coast, or 9
yeah,
a.m. at 2 p.m. in the UK. But then we might have a meeting at 8 a.m. Pacific time and 4 p.m.
yes,
The UK. It starts being a little bit more difficult, the window that we have in order to
yes.
talk to the customer, right?
Absolutely, absolutely. So that's a good point. I mean, I think, like you said, in terms of inbound inquiries, we were just taking them wherever they came from if we had a good product fit. But then I think in terms of setting up our
Yeah,
company and opening our office, we really thought about that point quite deeply.
yeah,
But I'm quite kind of public in the fact that I'm a huge kind of supporter and advocate of Silicon Valley. And
yeah.
look, you can build a software company anywhere in the world and you can raise money anywhere in the world. So I'm not saying you cannot do it another way. But what I looked at is when I looked at all of the best software companies, or not all of them, but many of them, they were kind of headquartered in the Bay Area. And when I spoke to investors in different parts of the world, there was no doubt that West Coast investors really kind of got the vision and were willing to kind of invest and really wanted to create something significant and impactful, rather than something kind of more kind of moderate. And so my view was, if I'm going to relocate and move country from the UK to the US, to build a software company, then I'm definitely going to go to the West Coast and we'll figure that stuff out. We'll figure the time zone and the meeting times out, but really wanted to be based here. And that's definitely served us very, very well. So it was, I think for us, it was the right decision to jump straight from the UK to the West Coast.
Yeah. And we'll get back here later just to keep everyone following the show. Why the typical decision, okay, let's go to California and to the Valley. And now should we stay in the Valley or go directly to the city center to San Francisco? And also you move it in 2020 before or almost at the same time of your A round, right? That we will
Yes.
also discuss more a bit later. But let's give a step back around this transition, right? Of having a very successful services business and having the commitment to move forward to start a product business in, let's say, in the same industry or in the same category, but with a very different mindset compared to a services business, much more a product SaaS business. So why did you decide to, take what was kind of stable and maybe a very good business to risk it all and start and go for maybe much more potential in terms of the growth of the business, but also starting from scratch again, right?
Yeah, absolutely. So I think I've been doing the previous thing for a long time, and it was in different forms. So we had, a couple of different companies that we built, but essentially it was that formula you described of build it steadily, profitably, grow carefully. And, frankly, that was very rewarding and learned a lot and had great customers and also had a great lifestyle because it was profitable and, life was pretty good. But it was also clear that it could never be big. It could never be, and it could never have a huge impact. It would never be, for example, category creating. It would just be another services company. And it's kind of, you might say it was successful, and it was relatively successful, but it was small scale. So I kind of could see the potential to build a significant product in this space and build this category, and looked at other software companies, especially again in the Bay Area, who literally were building and going public. And I thought, I really think this is something we could do. And if I don't try this, then I'll regret it. I'll look back later and wonder if we could have done it. And having done this services thing for many, many years, I've got to do it. I'm getting old as well. So now is the time to do it. And of course, I spoke to friends and peers and advisors, and I said, here's my options. And they all unanimously said, look, you need to go for this because it looks like a great proposition and you've got every chance of success. And again, you'll regret it if you don't do it.
How did you plan the transition? So did you sell the services business and then with the profits you started the product business? Did you close the services business? I assume it was also the same co-founder who started the services business that went forward to start the product business. So easy there, right? So
yeah, absolutely. So good questions.
Not easy.
So we did a careful transition, and I remember I came out in let me get this right. I came out in 2018 to the Bay Area and started meeting some investors then, and then got a clear idea of what our trajectory would need to be to raise a Series A. And then it took me, I think my wife said to me, you've got 6 months to do this and make it happen. And in the end, it took me about 18 months, not 6 months, to really focus on the product, build that momentum and that trajectory, and then transition away the services. And we did that in a couple of ways. So we did divest a couple of business units, and they were taken over and acquired or whatever. And then we did also kind of close down some of it over time, and even after the Series A, for example, we still continued for say a year just to gradually wind down some of those services, and we didn't want to disappoint customers in a big way, so we gave them time and we helped them to make other arrangements. So it was really a combination of divesting a few things and then transitioning. And the key thing is we transitioned our people, because all of our engineers were spending some of their time building our own products and then some of their time building products for other people. And we retained basically all of them. We just basically moved them from being, say, 25% our product to 100% our product over the course of maybe 1 year.
So was it still the same legal entity, or did you create a new legal entity
Yeah,
to do the transition?
we created a new one, and the main reason for that was we wanted it to be a US company, and
Okay,
before it was a UK company. So we created
makes
a
sense.
brand new US entity, and then we actually made
The new branding.
the
Yep.
we kind of moved the UK to be a subsidiary, so slightly revised structure.
Got it. Makes a lot of sense. And can you just give us a flavor of what was kind of, without disclosing any private information, but what was kind of the size of those businesses, of
Yeah,
those two services business when you decided to move to the product business?
absolutely. I mean, I would say we probably were around probably around say 5 million of revenue as a profitable services business, and of
Yeah.
that, let's say 2 million, maybe a bit more, 2 million was recurring kind of
Ready.
revenue,
Yeah.
and then 3 million was kind of just one-off services. So that was about what the point we were at, and that was
Yeah.
after selling the Enable Informatrix business, which we did a few years before that you noted, but the kind of services business we had at the time
Yeah.
was about 5 million revenue.
Got it. And in terms of head count, where were you landing at the time?
I would say it was about 50 people probably at the point where 2018, again, I'd come out to the
Yeah.
Bay Area, and yeah, about 50 people.
So I would assume kind of the 20% EBITDA margins, so
Yeah.
reasonable margins and great business, even able to be sold by a nice multiple, right? As you did your first one, and having in mind sometimes the software margins are even higher, right? Depending
Yes.
on the moment if you are investing in new product development or not, right? More aggressively or less aggressively.
Yes. Yeah. Yeah. Maybe 20% is a little bit generous, but let's call it double digit.
Okay.
Double digit EBITDA margin. How
No,
about that?
it's really nice to, that nowadays we are also talking more about profitability and cash generation. And I think this was also a nice transition of your mindset, right? So especially at the time where the markets were very aggressive, and especially until 21 or 2021, maybe beginning of 2022, and then we saw this downturn and investors being more protective or wanting to see um, no growth at all costs, a little bit more conservative in terms of burn. So how was this mindset of having an operation under control, being profitable, not having all recurring revenue, but having services revenue, some stability, also headcount 50 people. That's nice. That's already a good structure, but not also too big to manage, not with
Mm,
all those growth pains that also come with 80 and 100 people, and then 250 and 500 people
yes.
now. So how has been your mindset shift to be able to deal with the two different realities, right?
Sure. Absolutely. So, and I think first of all, there were lots of things that were good about the previous model, but the kind of uh, clarity of vision, and that we were so excited about what we could build in our product that we just kind of had to do it. I mean, it wasn't for me. It wasn't in the end. It
Yeah.
wasn't a difficult decision because it was just so clear this is what we had to do, and the opportunity was in front of us. And then I think you're right that transitioning from a bootstrap situation where we had a very limited bank balance, and we had to be very, very careful, and I remember I used to sign off every single payment to any supplier and every single purchase, and I even used to look at the debtors every day and say who owes us money and how are we collecting this money, to then one where suddenly you've got, in a Series A we raised $17 million, and so your bank balance goes from close to zero to 17 million. And then the investors are obviously
Not
saying,
bad.
where are you going to actually deploy this
Right.
these funds? And I remember, a couple of investors, not the ones we ended up going with, but prior to that, said one of our concerns, Andrew, is you're such a frugal, bootstrapped founder that we're not sure you'd actually be able to spend the money and actually get your head around a burn situation. We don't
Right.
know. So that was interesting. But I think I have to say, once we got started, we shut down the services and we were really kind of going full speed
Mhm.
ahead with the product. we started to burn quite, we did start to burn. And then as we took on some really talented people that had done this before, and so I'd say we had really good engineering and really good product and some happy early customers, but we didn't really have many salespeople. And when we hired some very strong sales leadership, they knew what was required in terms of investment, and the burn started to increase in a controlled way, but it did increase. And then you're right, what happened not that long later was then investors saying, actually, we should think about our efficiency and can we burn less. So it was like that cycle of
Right.
not burning anything, and concerns about that we wouldn't actually use the funds,
Right.
to actually maybe you're burning a bit too much, can you burn less? So it's been an
Yeah.
interesting cycle.
And in a certain way, you also transition for a product organization and you start divesting the services side. So, which means that you didn't raise a pre-seed round, neither a seed round. I assume you already started almost with maybe the 2.5 million. So, and then you get to the point that you are almost able to to keep growing a product organization without raising money. So it's not kind of the discussion about I need to move from a services to a product organization that is more scalable, but I don't need to raise money if I want to grow at a certain pace. Maybe if I want to speed up and win the category or go to a larger to a bigger vision, then I need to raise that capital, because it's not something that you are just raising the pre-seed and the seed round to get to your first million in revenue. No, you are deciding already that you are raising a Series A in February of 20, which is a
Yeah.
17 million round, as you said, with again product market fit achieved already, and almost maybe aligning or fine-tuning your go-to-market fit, right?
Yes. That's all true. That's all true. And so we already had that revenue and customers. But I think the reason we raised in the first place was to genuinely be able to build a category and build a significant global and impactful business. So
Mm-hmm.
so I had options. I could have kind of continued bootstrapping and going very slowly. I could
Yeah.
have raised a little bit of investment, maybe in the UK where I was, more kind of, okay, we're raising a couple of million maybe, and that will give us a bit more potential and allow
Right.
us to go a bit faster. But still, it's never going to be a new category. And then on the other extreme was, come to the Bay Area and really demonstrate how this could be 100 million of revenue. And I think in those days, 3 years ago, that was the key thing. Can you prove to an investor that this absolutely can be 100 million, at least?
Right.
And I think now the bar's a lot higher, and we've made a lot of progress anyway. So now maybe I should say a billion. Can
Right.
this be a billion-dollar revenue company? And the answer is yes, it absolutely can be. But there's no way you would do that if you were going very, very slowly. You have to kind of really invest, and that's why I chose to invest
Yeah.
in the end, raise quite significant amounts of capital.
And just to highlight, I think this is a great ambition to have. You are not talking about the billion valuation, the unicorn valuation. You are talking about the billion in revenue.
Of revenue,
So
correct.
going
Absolutely.
to the next stage, which would be to go from the 100 million to the 1 billion revenue,
Yeah.
maybe being a listed company or not, maybe a private company going for
Oh,
IPO and
yeah.
scaling,
And I,
right?
I think that this is just another great thing about the Bay Area. And I'm not on commission or being paid to sell the sell the region, but one of the founders who really inspires me is Michelle Zatlin, who founded or co-founded Cloudflare. Okay, and
Mhm.
and she
Yeah.
literally founded it, scaled it to around 1 billion in revenue now, and it's still growing very fast. And she's still the COO of the company, and that's just amazing. And that's one I've spoken
Amazing.
to a couple of times. And then I also was with the CEO of Workiva the other day, who
Mhm.
and that now again is in the many hundreds of millions, maybe I can't remember, maybe it's 600 million of revenue. And these people, this is absolutely achievable
Keeps
and
going.
doable. And that, yeah, the people here they're very accessible. So
Yeah.
I think when I was thinking about can we ever get to 100 million, 100 million in revenue, to be honest, that it seemed like a really big number, and I wasn't completely
Yeah.
sure. But now I do think, we can get this to 1 billion of revenue. I mean, it doesn't mean it's guaranteed, and I think it will take time to do, but it's definitely doable.
Yeah. It's the benefit of having the right peers around you and people with experience who have done this before, and being able to first see them doing it and saying and thinking to yourself, it is possible, right? Which already helps. When sometimes where we are in other countries where the economies are much smaller, and
Yeah,
almost those people are not accessible as you were saying. It seems
yeah,
kind of a dream, something that
exactly.
is not realistic to aim
Yeah.
for, right?
It's so true, and I'm kind of proud to be British and really like the UK,
Yeah.
but the culture is very different, and I'd say there was no idea that that kind of potential would be possible where I came from, but here that's totally possible, and that's made a huge positive impact in being able to be around those people, learn from those people, talk to those people, and then
Yeah.
apply that kind of thinking into our business.
Just have this think big mentality, and I think that that's also a difficult combination to have, right? Is to stay confident, humble, and at the same time, yeah, humble and confident, and being able to take the risk and have the courage to think big. Because of course it's much easier to define a smaller vision than putting ourselves to an uncomfortable very big vision, and of course our chances of failing are much higher. But that's the good part. There is people appreciate that you are
Mm.
exposing yourself and trying to do something big, right?
Yeah, I think
With
so. I mean,
impact.
I think the other thing is to break it down into kind of time horizons, and I've done
Yeah,
exactly this. So to say,
correct.
okay, we definitely can be at this kind of position long term. It's
Love
definitely
it.
doable and possible, and maybe probable, but that's a long time away. So what does, let's say, the 2 years leading up to that look like, and then how do we get to that kind of stage? What do we need to do right now? And I think having really good data, and the data is essential. So I think we both would agree you can't just have a big vision and then that's it. I mean,
Right.
you've got to
Yeah.
be able to kind of yeah, track the journey ahead, and then look at what kind of data is relevant and meaningful, and you've got to be able to justify that and say this is why this is meaningful, and then track to it. And that's what we do. So we still have very, very
Yeah.
kind of major monthly and quarterly tracking to make sure we're going the right way, and if things are going in the wrong direction, then we will adjust course quickly.
Yeah. And Andrew, let's get back to the fundraising part. So in February of 2020, you raised the 17 million A round. Then in June of 21, kind of almost a year later, a bit more, 15 months or 16, you raised the B round, which was how much?
45 million.
45. Yeah, I was
Yeah,
just doing the calculation about the total
yeah,
that you said. And now, as I said, in October of 22, you raised the 94 million C round, which gets a total of 156 million raised so far. Also from June to October, and now again, the 14, 15, or 16, 14 in this case, months. So which is kind
yeah,
of almost every year, every 12 to 15 months, raising the next rounds. I assume during those stages you were able to keep growing more than 100% year over year. That's the only
yes,
way to keep raising in such a short period of time, right? Kind of following the playbook of growth,
yes,
which is not easy at all. I know that you have some ideas and some convictions about how to manage the timing and the size of the rounds, also how the impact of the valuation can have in your round. So if you could kind of summarize, I know it's a tough question to ask in such a short period of time, but some of your lessons learned about fundraising, it would be great. Yeah.
sure. Yeah, so I think the Series A was the most difficult of the three because, and we've covered a lot of this already, haven't we? That I kind of turned up here from the UK, and didn't even have a US company, barely had a US bank account, and was then kind of knocking on doors saying, this is what we're doing. Nobody had heard of Rebates and didn't really see that it was an important or big space like they do now, by the way, and it's now recognized as being, really, really big. And so that was quite challenging. And we had to get from this kind of bootstrap situation to some capital on the balance sheet, because otherwise we wouldn't have survived, because we were shutting down the services business, and that was what was producing our funding. So that was just step one. And we were very fortunate that we met Menlo Ventures, for example. They led the Series A, and the people there, Steve Sloan, who's on our board, and Venki Ganesan, who's been at Menlo a long time, they really saw the vision, and they had that vision to invest very early. So I'm always eternally grateful to them. So that was the first stage. And at that point, again, we had very little go-to-market. So we had the product, we had some customers, and we were kind of hiring our first salespeople in the US, like literally the first one, the second one, third one. But I think a big turning point was we brought an amazing revenue leader on board, and he actually had been at another Menlo funded company, Jerry Bruner, and this company had done extremely well and had just been acquired by Workday. And I think there's no doubt he'd contributed in a big way to that growth, and he was a very experienced revenue leader. So to cut a long story short, I was again very fortunate that I managed to attract Jerry to come to Enable, and he said, right, this is huge potential, but we need to invest significantly in setting up the whole kind of revenue team and all the functions that go with that, and that's going to require going at a faster pace. Now, fortunately, that also attracted other investors to come to us and said, oh, we can see what Enable's doing, really interesting, and also we've seen Jerry and what he did, with the previous company. So that was a big market signal, and so we actually then had investors coming to us at the B, and it was very similar at the C. Because once again, we were, like you said, we were creating that performance. We were growing over 100% year over year, and word spread quickly. So with the B and the C, we just had people coming to us, and it got to the point where we didn't necessarily need to raise, but it's saying, what could we do? How could we go faster? How could we build a stronger business? And also, if you can raise with minimal dilution, and you've got people making those offers, then it's often a good idea to take that capital.
Got it. And something that you also added to this equation are the advantages of moving to the Valley, especially some years ago. Now we are seeing more and more people coming from other places, but still the US leads there. Is the number of operators and senior leaders that you have available in terms of the talent pipeline.
No question.
There's no comparison.
Yeah,
given the size.
There's no comparison, and some of these people that we've brought on, there's just no way, in my opinion, and again, I could be wrong, but in my opinion, I think if we hadn't been here and in the ecosystem and able to meet people and see them face to face, then we wouldn't have found and been able to hire the people that we did.
And we know that as a CEO at that stage, especially when we are scaling up, it's all about having the right people on the right seats in the leadership team, and then they are able. And usually there is again a lot of humility coming from the CEO to understand and follow, kind of setting up the vision and the direction, but then letting people tell you how you should structure the different functions and letting it go and letting them lead, right? Because they've done it before, so they know what to tell you. Just need to provide the overall vision and be the guardian of the mission, vision, and values of the company.
Yes, exactly. And you reminded me that you asked me earlier about how was it transitioning from 50 people to over 500 people, and in some ways it's actually not very different, because to your point just now, we've got such strong people. So I've got a very strong president and CRO. I've got a very strong chief operating officer, CFO, and others, and they are running their teams, which are significant in size. And I've trusted them to do that. That they're better than I am, at least in those functions. So then for me, yes, within our all hands meeting, we have 500 and however many people rather than 50. But on a day-to-day basis, we've got very strong managers who are kind of running the functions.
This is a very nice insight. I've just interviewed recently Joel Trammell, He's called kind of the American CEO, the author of the book, The CEO Operating System. And I was asking him, so he was able to lead two VC-backed companies and sold them, bootstrapped two companies as well, led a public company as the CEO. And he was saying exactly what you were saying, kind of a 200 team size is almost as leading a 3,000 team member company, because you are still dealing with the executive team and with the leadership team, right? So
Yes.
maybe what is a little bit different is for the CRO or the CMO, for the CFO, the chief people, because then they have more layers that they need to be able to coordinate. But the CEO is still talking to those 5 to 7 people that are the C-suite that they need to lead if they are doing it properly, of course, and not trying to be everywhere.
Yes, yeah, that's right. And I think it's a privileged position to be in, because
Yeah.
I can kind of go and speak to whoever I want to, obviously, and go direct to people who are experts in their area and talk to them. But then I'm not managing them on a day-to-day basis. You know, they report into someone else. So I get the
Right.
benefit of people's expertise, but without having to manage them. I think what has changed more is originally, when it was just my co-founder and me, there were no investors and there was no board really.
Right.
Um, so then of course there was a board, but the board was simple because the board just had the investors on it who invested in the Series A, and that was it.
Mm-hmm.
And then of course you start to get to, okay, you've got your board, you've got your Series A, B, C investors who might be on that board. Then you've got other investors that are not on the board, so you need to
Good
manage
point.
them, and those kind of stakeholder groups of are going up in size and complexity. So in
Right.
a way, that has been a bigger adjustment than just the number of people that we employ.
Yeah. So it's really, we are talking that the CEO is always managing a marketplace, right? So we have always the customers and the employees, and nowadays we really understand that we need to have a value proposition for both again, and that's why culture is, and the vision and the mission, the values are so important, right? But at the same time, we also need to be able to balance, as the CEO, the interests of the shareholders, the customers, and the employees. And if any of them is being abused, it will not
Yeah,
be sustainable, right? So if shareholders are not happy, or if shareholders are happy but customers and employees are having an awful experience, it will not work. If customers are super happy but employees are having a shitty day and shareholders are not seeing the benefits, it doesn't
yeah,
work. Or we can even say, let's say that shareholders are happy and the customers are happy, but the employees are not happy at all.
yeah,
It will be
yeah.
very difficult to sustain that business for a long period of time, right?
That's true. It's keeping it all in balance. And I think for me, I always say the purpose of a business is to serve customers. That's the reason a business exists, and to deliver more value than the business is being paid. So if you pay us
Like it.
$100 a year, you need to get at least $200 a year of value, and also you need to be happy, which is more subjective, isn't it? So if you're
Yeah.
so that's the main thing. And then if you can achieve that, then the business is there as a model to replicate customer success. So we've made you successful, you're happy, and you're getting 100% ROI. How can we replicate that to 1,000 customers? And
Yeah.
then it's very mission driven. Of we're on this mission to create all this customer value, and you can attract employees who really are excited about that mission, and then you can attract investors as well. But that's how I think
Yeah.
about it.
So as we promised it in the beginning, and time is flying very aggressively. So why then you decided to move from the UK to California and raise your A rounds in the Valley? So why did you decide to be located in San Francisco and not in the Valley, let's say?
Sure. Yeah. So initially, my wife and I were going to settle down in the valley, and we came from the middle of the UK where we had lots of space, and so we weren't drawn to a city.
Right.
But a lot of the advice I had was, um, there's so much going on in San Francisco. A lot of talent, and a lot of the investors are actually also in the city as well as the valley, and if they're not, they're opening up in the city. And more than anything, if you're going to move halfway across the world to California, then why don't you really need to try check out the city for a couple of years at least, just go and tick the box and say you've done it,
Right.
and then move out. So and then in the end, we were just lucky. We just found a place that we really liked, and it went from there. I think practically speaking, what I find is anyone that I might want to talk to in the Bay Area either is in the city, or if they're not, they come into the city regularly. So you can just say, they'll say, "Oh, I'm going to be in the city next Wednesday," and I could just meet them then. Whereas if
Right.
you were not in the city, you would probably end up having to drive into the city quite often. And then fundamentally, I've just really enjoyed living here. So having been here now for 3 years, 3.5 years, um, we just, we like it so much that much better than I expected, and wouldn't want to move.
Okay, so now you are not thinking about going down to
No,
Mountain View or to
no.
other places,
No, no, and
San
of course
Jose.
I
Yeah.
travel down there and see people there, but so
Yeah.
that's great. But I definitely enjoy living in the city, and will keep living here.
So cool. Any other key takeaway that you'd like to share about the company and your path that we were not able to cover before we go to the last segments of the show, Andrew?
Yeah, I mean, I think this it's just something. The space that we're in is something which is not widely recognized in the world, but 80% of global trade, 80% of GDP goes through the supply chain. It doesn't go straight from a manufacturer to the customer. It goes through distributors, retailers, wholesalers, dealers, resellers, you name it. And we've been talking about supply chain digitization for 20 years, but the fact is it still doesn't really exist. All of the tech and investment has gone into that very thin layer of business to consumer or business to business. The entire kind of supply chain behind that is still virtually on paper and
Right.
fax machines and EDI and this type of thing. So really what we're saying is we're building a complete kind of collaboration platform for the supply chain to work better together so it can serve customers. We started with this rebate space, which is huge, and rebates are the currency of the supply chain. They drive behavior, they get partners aligned. So we're really putting that on the map. And I mean, literally, G2 have created a category, or are creating a category this month for what we're doing. It's taken this
So
long, but they're doing it now. Gartner, they've just produced a market guide which mentions this. They hadn't done until now. So this is genuinely category creation, and that's what we're doing.
sounds super exciting, and congratulations for the journey so far, Andrew.
Thank you.
Amazing path. So let's go to the last segment of the show where we kind of have here a quick question and answer dynamic. So if you would have the opportunity to have a coffee with Andrew in December of 2016, when he decided to move from the services organization to the product organization, what advice would you offer to your younger Andrew?
Yeah, I think it would be that you need to be very intentional about what you're doing, have a lot of clarity on what you're trying to achieve, because there's so many different ways to build a company, and different routes you can take. So you need to be very deliberate and clear and intentional about that. I think, as you can see, it's worked very well so far, and we've had a really good kind of 3 years. So it definitely was the right thing to do. And I think having that focus and having, like you said earlier, having the courage to kind of jump in and do that and focus. And it's always hard to turn other things away and say no, and shut things down. That's against human nature. But I think that can be the right thing to do, if you have a lot of focus and intention about where you want to get to.
Absolutely. To have clarity about your narrative of the future, and being able to be an evangelist about that narrative across the company, right?
Yes.
What are you the most proud of on your journey so far?
Yeah, and I think we have made a lot of people successful. So we've certainly, let's talk again about customers first. Like I said, for me, customers do come first, and we've got a lot of very, very successful customers that have used and are using our product to get substantial returns on their revenue, their profitability, as well as actually making their life a lot easier. So that's the more subjective stuff, but it's really helped to free them up from the kind of agony of Excel spreadsheets and that type of thing. Um, We've also made our employees successful. We've had a lot of people start at the bottom, at junior positions, and work their way right up, and they've had very successful, rewarding careers. I definitely I want to make our investors successful as well, and there's no doubt you can imagine the Series A and the Series B, that we've already kind of done quite well, and Series C is still quite early days, but that will be good as well. So yeah, I think I'm certainly proud that we are making an impact, a positive impact, and just creating value and success for all of those stakeholders.
Love it. Worst advice ever received?
I mean, I think this is a bit of a tough one. I can't think of anything instantly. I think, again, the mindset I came from was kind of one of just ignorance of how to build a company of scale, and much more about things like you have to be profitable on day one. You can't invest in growth, or you need to be extremely kind of cautious about that, and that investors are bad. I mean, there's so many people are kind of terrified and saying, oh no, we can't bring in an investor, or we can't have any dilution, we can't bring in. I think that's bad advice. I think for me, someone said this to me, this is about making the pie bigger. So it's not about giving some of the pie away,
Right.
or having less of the pie. This is about actually making a bigger pie. You issue new stock, and then you raise capital, and then you invest, and you build a bigger company. So I think bad advice about don't raise capital, or don't deal with investors. And I think you said earlier, a lot of people don't think big. I think constantly people are trying to say no, or shut you down, or get you to think smaller, or telling you it's not possible, and that's not good advice. You can definitely
Right.
achieve something big if you put your mind to it.
That's great. That's all we want here at the Scale Up Valley podcast, is to promote this mindset that even if we are not able to get there, at least we learn, and we never ever give up of trying to get there, right? So it's better to move our standards up instead of moving our dreams down.
Yeah, I think this is really important that you say that as well. That there's a lot of obstacles, and a lot of pushback, and people saying no everywhere, every day, and failures. There's a lot of failure, and I think it's those people that just keep going, and that most people do give up. Most of us do give up, quite quickly, really. But I think history shows us that those that really just are able to keep going will actually get to success, and that's what I've certainly learned that so far.
Yeah. And we will skip the favorite movie series and the favorite podcast, because I know that you are not confident about your recommendations there. So let's close with your favorite book.
So one of my real favorites, and we were talking about clarity earlier. I really like Patrick Lencioni, who wrote Five Dysfunctions of a Team, and a lot of
Yeah.
people I'm sure are familiar with that. But actually, my favorite book that he wrote is The Advantage. And The Advantage is all about creating clarity and organizational health, and how organizational health is a big competitive differentiator, because let's face it, most companies do not have very good organizational health. So that is a really easy to read and compelling kind of book, which talks through how to create that organizational clarity with a few simple questions.
Love it. And another recommendation that I have there is really another book that very few people are aware about, the same author, which is The Five Temptations of a CEO. I really enjoy that one as well. Cool. Andrew, it has been a pleasure to have you on the show. Congrats again for the journey, and you are always invited to come back to keep sharing the next chapters of growth.
Thank you very much. I've really enjoyed the conversation, Mike. So thanks for having me.
Likewise. And to our community, thanks for being there. We keep bringing you the best of the best to make your life a little bit easier as you scale up your company. See you soon, and keep scaling.